Gold is now down 18% since its top in January after a brief rebound following the February 2nd crash. It's gone down again, and just today on the 19th of March, gold is down about 6% intraday. As we're speaking after hours, after the market's closed, it's now rebounding about 1%, but it's closing around $4,600 around 8 p.m. Eastern Time. Gary Wagner, editor of thegoldforecast.com, is back with us to give us his outlook and explain what is going on. Why is gold, and to a certain extent, why are gold and silver crashing? Gary, welcome back to the show. Good to see you.
Thanks for having me. And there's a Chinese saying that may you get what you wish for, which on the surface sounds as a compliment, but it's actually a curse. And that's the best way to describe it. We got what we wanted when gold rose to the peak above 5,600. I believe we had a 16% year-to-date gain. That's down to about 5 or 6% year-to-date. So we've definitely seen the market come under major pressure. And my question that I've been looking to answer is whether or not we're witnessing a deep but acceptable correction or a pivot from bullish to bearish.
Okay, Gary, let's just flip over to a chart, please, and take a look at the technicals. So we have a situation that, to me, at least, looks like a double top. Mm-hmm. Gold spiking around $5,500 and coming back down. This is exactly what happened in 2011 and to a certain extent 1980 as well. And we know what happened both times. It went down 50%.
Correct.
We don't know if it's going to go down another 50%. I'm just saying that it looks like the beginning of that kind of pattern. Do you, as a technician, see any similarities, or am I off base here?
No, I think you're correct and spot on. But we are at a critical point. Gold has declined on my short-term fib retracement that I have up here, below the 61, but above the 78% correction level. 78% to a market technician, although this is a short Fibonacci data set that I'm using for the retracement, is still within the realm of a simple but deep correction rather than a pivot from bullish to bearish. On the other side, you can see that gold broke through the simple 50-day moving average, which is a major line in the sand for most market technicians. Below a 78% correction starts to reveal that the probability that we are witnessing a pivot from bullish to bearish is in play. And the interesting thing is this is occurring with great strife in terms of the military conflict between Iran, multiple countries, and Israel and the U.S., which did attack them. And while I'm not offering you a definitive answer whether it's a pivot to bullish, bearish, or a correction, we need a little bit more data, but we're right on the line of where that could happen. And it does look like the potential that we're witnessing a pivot is real when we look at the charts. But considering the fundamentals at play, nothing has really changed. The anticipation was that the Fed would maintain rates where they were, but yet when that announcement came out, it dropped tremendously. We've had, on a candlestick chart, four consecutive lower lows and lower highs. In the middle, you see a double doji there. And that usually means that there's indecision in the market. We could expect a bounce up, but what we saw today was a continuation of selling pressure when, except for the announcement by the Fed, which was a high probability, I think it was about 98%, according to the CME's FedWatch tool, that they would maintain them. So we are getting closer to the point where I will say it is likely we're witnessing a reversal, but my mind tells me that fundamentally nothing has really changed, so why would you get that major pivot?
So I will point out that Gary has correctly not only called the direction to the top, but also the direction to the bottom. late January, when you came on the show, you had said that you're expecting gold to retrace back towards $5,200, 51 to 5,250 to be exact. It's done exactly that. When gold broke through the floor below 5,100, Gary, for the first time, what was your reaction?
Well, my reaction was that obviously I was short. I might have gotten the direction right, but my levels didn't equal the actual market moves. So in that way, it's troublesome to me. But as an analyst, I understand you don't always get things right because things can change. The quagmire here, the one thing that I'm attempting to absorb and explain in a rational manner is which the fundamentals at play now with the military action, not only involving the U.S. and Iran and Israel, but Iran attacking multiple Arabic countries that are around their border as kind of a revenge thing, because each country they've attacked, there's a U.S. base there. And so I think it's a little too early to make a really positive claim that we pivoted to bearish, because fundamentally that doesn't make sense. But technically, gold prices got frothy. They became dramatically overbought as we saw that rise up. And we know that when that happens, the likelihood is of a steep correction or a pivot. And that's going to take a little bit more data to answer. Right now, we are within, in my mind, acceptable parameters where it still could be a simple correction. My call of $6,000 is standing because I expected a correction, and it's early in the year. So by year end, to go to 6,000 would require that market sentiment of bullishness that's been prevalent for quite some time still remains. And I don't see a reason that that's changed. Although the Fed didn't cut rates, it was expected that they would maintain their current Fed funds rate. As far as inflation goes, the Fed considers hardcore target at 2%. We have been well above that for quite some time. It's 3.4, depending if you're looking, the data set that you're looking at in terms of time parameters. And so that's going to be troublesome to the Fed, but it has been troublesome to the Fed. And how do you change that? Typically, you lower rates, and they didn't do that.
The current U.S. fiscal deficit stands at over $1 trillion. And so if the government spends more than it takes in by the order of $1 trillion every single year, what does that mean for the purchasing power and value of your savings? Well, historically, governments don't fix deficits by cutting spending. They print their way out of debt. And when they do, hard assets like gold rise, while dollar-denominated savings lose purchasing power. Gold has been hovering around $5,000 an ounce. JP Morgan is projecting $6,300 this year, and central banks in India, China, and Japan, and Eastern Europe are already moving out of U.S. treasuries and into gold at the fastest rate in decades. If your IRA or 401k has no hard asset exposure, that's worth a conversation. My friends and sponsors of today's video, Priority Gold, are Forbes' #1 rated gold provider with thousands of 5-star reviews. 3 simple steps, no paperwork, no pressure, no obligation, and they'll do a free portfolio review so you know exactly where you stand. Call 866-407-6456. That's 866-407-6456, or text David, D-A-V-I-D, to 24999 to get your free precious metals playbook and up to $10,000 in free silver with qualifying purchases. Again, text David, D-A-V-I-D, to 24999 or 866-407-6456. The fact that gold should be responding to escalating tensions and an escalating war, I mean, it went the other way, right? And this is a question that I've been asking people. Yes, gold should be responding to lower rates. It hasn't happened yet. But if you notice something very interesting, Gary, after February 28th, which was the day that the U.S. and Israel commenced the strikes on Iran, the DXY, the dollar index, rallied. And it looks like the world flocked to the dollar once more as a safe haven asset and not to gold. And of course, gold
Correct.
sold off. Maybe just comment on that. And
Certainly.
yeah,
That to me is an easier question than how low will it go. Gold and the dollar have both been considered safe havens for decades. And when we saw the run up, they were obviously investors by their positions that are reported were showing that they were still overall bullish. This recent move shows that there was a shift. That's what's been driving it down. And the interesting thing is happening when nothing has changed except the level of uncertainty and geopolitical military action has elevated, which should maintain at least the price of gold, if not take it higher, and we're not seeing that. The only response I can give is crude oil has been extremely volatile. It broke above 100 just a few days ago. It's now just below it at about 97. And so that indicates the potential for money managers and professional traders to shift from either the dollar or gold into crude oil. That would make sense to me, meaning that it doesn't mean that the sentiment in gold has changed so much. It's been rising against a tremendously strong dollar that's been rising in terms of percentage gains, much more than we typically see in that currency, our currency. And so the only explanation that I can offer that makes sense to me is that the professional hedge funds, the people that are holding the largest positions in futures have made a strategic shift from gold and the dollar to crude light.
okay. So when you evaluate the question of how low something can go after it's broken down technically, just walk us through the thought process here. Walk us through your methodology.
Sure. If you look at this chart here, I've got a very short-term fib retracement that starts really at the beginning of the year and then goes up to the all-time record high, meaning this last major rally. It fell from grace hard. In 2 days, it gave up a huge percentage point, and that's this red candle and this red candle here. But it is still above the 78% retracement. That is an acceptable level for a correction rather than a pivot. What challenges that assumption is the simple 50-day moving average is the line that's in green. The other day we broke below that. And that's another kind of line in the sand for a market technician. If equity or an asset group or an asset class is trading above the simple 50-day moving average, we consider that to be still in a bullish demeanor with positive market sentiment. A break below that is the opposite. We believe that this is giving us technical, empirical, in other words, analysis that's a hard line in the sand using the 50-day. And we are definitely below that. We broke through that the other day. So as long as we remain above on my chart, that 78% retracement, and that comes in at 45.68, we can still make the case of the potential that there wasn't a pivot, but a steep correction. And the steep correction, that makes sense to me. Gold got overheated. It got frothy. It went up tremendously to an all-time record high above $5,600. I'm looking at April futures on my chart, and then just crashed through that level with a vengeance, almost $1,000 correction, which if you look at gold at $5,000 or above, that's about 20%. So the evidence isn't concrete, but it's looking more like a pivot, which does not make sense in my mind, because no matter what a chart shows, we all recognize, the market technicians that use this kind of data in a chart, that it is fundamentals that creates market sentiment, not necessarily a line in the sand like a 50-day moving average or a fib retracement. And so that's where I've got hardcore evidence that it could go one way or the other. but I'm not convinced that there was a major pivot, and that's what we're looking for. Corrections are to be expected, but we haven't had a pivot from the bullish demeanor, which has been going on for quite some time, and this could be a moment that we're getting it, but there's no confluence with the fundamental data because hardcore, we're not yet at a point in terms of the retracement, but I can move that data set and make it longer or shorter. If I make it longer, we're right at the 38% retracement, a real acceptable correction. On the short-term fib, which I have up, we're approaching 78. We've broken through the 50-day moving average. That's a red flag. If we break through the 78% retracement, I will have to acknowledge that there is not overwhelming, but good technical evidence that a fundamental shift in market sentiment has taken place. We're not there yet, but we are right on that line in the sand.
Okay, let's move on to talk about this chart here. This is a crude oil chart that's circulating on X. Crude oil prices surged to historic records, 1986 to 2025. 2026 is this orange line. In terms of a year-to-date gain on a percentage basis, it seems to be unprecedented. How far oil has climbed in the first 40 or so 45 days of the year. If you take a look at my screen now at gold versus oil. So gold is the bar chart and oil is now the Brent price is the blue line. There is no direct correlation. It's not positive or negative, although broadly speaking, over the last couple years, you can sort of see that they've moved in opposite directions. Certainly that's the case now. While other metals like silver, copper, palladium, platinum have just in the last couple of weeks, if not months, broadly moved in line with gold. Can you maybe explain from a macro perspective why gold and oil have tended to trade in the opposite directions?
Well, higher oil represents the potential for higher inflation, and gold typically thrives as inflation moves up. So that doesn't align up. So then we have to look at market sentiment, because the facts are that chart, and if you look from 2026, they're both moving up tremendously, although this has been a more subtle movement, and this is your gold chart, and crude oil has just spiked literally in terms of percentage gains well above that. That makes sense, the part of crude oil spiking with where the military conflict is located. That strait is where about 20% of world production needs to pass through. Now they've amended that because they're letting certain ships go through and only fighting back against U.S., Israel, and any Arab country that has a U.S. military base. And that's logical, not what we want. And that's why we're seeing crude oil spike and have this kind of volatility. We haven't seen oil above $100 a barrel in quite some time. We absolutely went above it briefly, and then we're below it, I believe. Currently, we're about 97 per barrel, and this is basis the most active futures contract month. But there's things that make sense, and honestly, what we're seeing is a split between what the fundamentals are telling us should happen, not in oil, but in gold. Because the fact that gold has sold off so briskly when the fundamentals are so hot, so to speak, are the right environment for gold to move higher. To me, there's only one explanation. For whatever reason, the large money, the hedge funds, the institutional traders have moved out of gold and into crude oil, believing that would get a better return right now. And that makes sense because nothing else in terms of why gold has gone down so much in times of geopolitical uncertainty. I mean, we've always assumed that gold works well in times of uncertainty. The more uncertain the times are, the more we'll see gold typically perform in a bullish manner to the upside. We certainly saw that as we reached the all-time record high, but the correction that we're witnessing now has been steep, and so has it crossed the line in the sand? I will say we're getting close to that point, and the technical fact I'm looking on is breaking through the 50-day simple moving average the other day. But the fundamentals and the technicals don't line up. And so then I have to shift, well, what fundamentally would have changed? And the only thing that's an explanation is big money shifting from gold and the dollar into crude.
So the fact that you're still maintaining your $6,000 gold price end of year target, that's several months away later in the year, Gary. If you were a more short-term trader and you were positioned just for the next quarter, would you be short gold right now?
I wouldn't. I would be concerned about being long. We are neutral right now, awaiting technical alignment with the fundamentals at play, because as long as there is that disparity where the fundamentals suggest one movement to, in a bullish manner, and the raw data watching gold sell off, we've had 6 down days. And of that, 4 of them were to new lows. There were a couple of dojis in the center, and that suggests a correction, a deep correction. And breaking through the 50-day, if it doesn't recover here and moves and breaks below the 78% retracement at 45.68 basis most active gold contract, which I believe is April now. We're getting a mixed message there. And whenever I get a mixed message, I've got to then refocus on the fundamentals and ask myself, what am I not seeing? Because obviously we've seen a dramatic sell-off. What's out there to explain it? And the best answer I can come up with is a switch from dollars and gold into crude light, because of the expectation that the more severe the action gets in that region, the more crude will be challenged and has potential to move much higher and maintain above $100 a barrel. I believe at 120, it really affects the pocketbooks of course, individuals, but more importantly in corporations, because regardless of what you do, with the exception of digital software, we're a petroleum-based society. That hasn't changed. And so we'll have to see.
All right. I'd like to play for you this clip from the FOMC conference yesterday. A reporter asked Powell a question that's on everybody's minds. Take a listen.
How high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. I think it's a more general concern than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Wait and see. Gary, what's your view? How much higher in the oil price before inflation really starts to tick up and impact monetary policy and perhaps even force them to raise rates? We don't know for sure, but we're just here to give a guideline.
But there's good data that suggests when oil gets above 120 a barrel, it really constrains everything from consumer spending, because they're putting such a larger percentage of fuel to, for driving to work and whatnot, and corporations that are heavily reliant on petroleum. So Above 100 is troublesome. Above 120 per barrel is that would be the critical area. And that's when, if it was on a sustained basis, even for a week, because we've seen it move up and have wild swings, it's still below $100 a barrel. According to economists, not myself, but respected economists, it's $120 per barrel, where it has a profound negative influence on individuals and corporations that are reliant on petroleum, because the bottom line is we are a petroleum-based civilization. And that's why that is such a hardcore commodity to move up dramatically or fall dramatically. And the effects that we'll see from that are what to be expected. There's a real concern of inflation. If oil gets to 120 and stays there, if it goes back below 100, it's still highly elevated. It's been much lower for a protracted amount of time. And it's been, I think, almost a decade since crude actually broke above 100 and stayed there. We haven't seen those days in quite some time. If that does happen, there could be profound implications on all of the asset classes as well as inflation.
Gary, can we take a look at a chart of silver? Silver is also down below $80 an ounce now. And I wonder if silver is just following gold or acting on its own. Maybe we'll pull up a chart and we can analyze that together.
So we're looking at a daily chart of silver futures. Right now, it still bases the most active March contract, but it will switch to the next most active, which is 3 months out from the March. And you can see, let me compress this a little bit. I've got my fib data set from about $48 per ounce. That occurred in November of last year, up to the all-time record high. And I know I didn't predict silver would move up that fast. I acknowledge that silver is like a candle burning at both ends. It is twice as bright, but it typically lasts half of the time. And the differential between that and only having it lit on one end is significant. But the drop that we witnessed was tremendous. If we go from here to here, we've surpassed the 61% retracement. This low here came to the 78, and this low here came really short of going, but it requires, you look at the length of this tail, this is what we saw today. Silver closed lower, but the low on the day was $65. It recovered back to 73, rounding up. And we're seeing the kind of volatility I would expect in silver versus gold. One, gold has a much greater liquidity due to the number of contracts that are in our open interest for the most active month. Silver does not. It's a much more concentrated trading vehicle. If someone's looking for a precious metal that's considered a safe haven, it is gold, with silver playing a far back second, and that would explain the kind of volatility that we're seeing. And silver historically has had really volatile moves, whether it's up or down. The difference of current data is that we've never seen silver above $100. I mean, the high was right around 50 for the last decade or so, and that's significant. And we saw silver run to above $120 per troy ounce, and that was an extremely overheated market, more frothy than gold when it went to an all-time record high. If you look at the differential, and that to me explains why we're seeing the kind of volatility we are in silver, with the huge moves both up and down.
Okay, very good. Gary, right now, if you had to choose between gold, silver, or oil, just from a purely technical perspective, which has more upside potential from here?
The longer the military conflict remains, the more you have to lean to crude oil. That's been outperforming both precious metals. I mean, even platinum and palladium, they've come down tremendously. So I would be foolish making the statement that given those two choices, I'm going to pick gold right now. Gold has not been performing in a bullish manner. The market sentiment seems to be uncertain, which means not necessarily that the big investors are selling into gold prices, rather that they're booking profits and liquidating positions. And that to me would explain why we've seen gold under pressure in a time when we haven't had definitive confirmation as to whether this is a simple correction or a pivot from bullish to bearish. The charts tell us that we're really close to making a call for that pivot, but then we have to look at market sentiment to gold and market sentiment to crude oil. And crude oil wins that fight because crude oil has run up so quickly, so fast, and is still at that elevated level, whereas gold went to that much earlier, but has now corrected. So obviously, I believe that the play right now has been switching from favoring the safe haven asset of the dollar, although that's been really strong, I believe 5% in a short period of time, and gold. When you compare both of those to crude, crude is outperforming both of them and able to sustain the move in lieu of what gold's done. The dollar could be top heavy here, but it hasn't really come down hard. So we can't make a case that the dollar's been correcting. The index is what I'm speaking about, not the buying power, but its relationship to a basket of currencies that compose the dollar index. But crude light right now is in lead if you can make that claim in terms of sustained percentage gains.
Okay. Thank you very much, Gary. We appreciate your update as always. And once again, congratulations on the right calls you've been making pretty much all year round in both directions, up and down. Obviously, the exact level, the top and bottom, nobody knows for sure, but you basically called the trends and the timing correctly. So very well done. We appreciate you. Where can we follow your work, Gary?
Thank you so much.
Where can we follow your work, Gary?
Oh, I'm sorry. TheGoldForecast.com is our website where you can read our daily letters. The videos, I've got about 2,700 videos from 2010 up to the current day. On YouTube, it goes out about a week after it's live, because if we're making a market call and recommending that our clients go short, long, or neutral, we have been neutral, but that's one of the perks in our service is that I do make these direct calls, and I always acknowledge whether I'm uncertain about something. The only thing I'm uncertain about right now is whether or not gold has made the pivot from bullish to bearish, or if we're in a correction. But thegoldforecast.com to look at our site and our performance tables and things like that. If you want to look at our library of videos on YouTube, it's the Gold Forecast.
Okay, here's a channel on my screen, goldforecast.com. Please go subscribe to Gary's YouTube channel, and I'll also put the links down below to thegoldforecast.com. Make sure to check out Gary's work there. We appreciate you, Gary. Thank you for coming on. See you next time.
You got it. Thank you.
Thank you for watching. Don't forget to like and subscribe.